Trust is the whole basis of how the financial system has to work. So the biggest thing to minimize the risk of a crisis is to keep a healthy level of bank capital, bank equity. The big thing countries should do and get together is regionally make sure all of the banks are reasonably well capitalized, so that if people think that there's going to be some losses or a small run on the bank, there's enough equity buffer there to keep that from making the bank fail, and then those fears of small runs won't turn into big runs. Second thing is, once there's a crisis going on, authorities have to prevent it from spreading. They can introduce more deposit insurance than it was around in advance. That's what they did in the United States during Silicon Valley. The deposits were insured up to $250,000. They ended up insuring all the deposits. That stopped it from spreading the panic, this crisis, into other mid-sized banks. That was a good policy. The other thing that you can do to reduce vulnerability is making clear that the supervisors and regulators are doing their job, that they're making sure that they're not zombie broke banks out there raising lots of uninsured deposits from businesses and households. So the policymakers essentially have to make sure that the transparency and supervision process is credible so that people who deal with a bank or a non-bank financial institution can be pretty sure if the bank or if non-bank institution is in business, they're probably reasonably solvent. Suppose the supervisors and the regulators do a good job of that. Now what's it up to the bankers? They've got to be reasonably transparent to the public about what their portfolio losses are. They don't want to hide those things. They have to make sure that the corporate governance in the bank is very good. You don't want related party lending to the managers' businesses or families. And once you don't have faith, then panics are the only response. On the capital market side, even more so, transparency is important. You have to make sure that the firms who are issuing securities are trustworthy, that the auditors are trustworthy, and that the numbers are believable. You need to have good, efficient, clean securities exchanges so that there's a good liquidity, there's a good ability to sell securities when needed, and when you can make individual households or institutions can sell them. That requires a slightly different type of regulations, transparency regulation. That's essential. For investment agencies, let's say money managers, they need to make sure that there are laws to make sure that money managers have a legal duty to look out for the client rather than themselves. In the United States, there's a big thing called the fiduciary rule. You have to make sure that the money manager acts as a fiduciary in certain circumstances, as opposed to looking out for themselves. Hong Kong has one great advantage. It has a history of being incredibly transparent and open. You have a lot of very highly skilled financial professionals who've been here for many years. I mean, if I were in charge of Hong Kong, I would try to make sure that human capital advantage doesn't dissipate over time, because once you've lost it, it's gone. And it's a great advantage that Hong Kong has. I looked through the entire program. There's an incredible number of sessions on just the most important problems in the world today, and very high-level people talking about them. This conference is doing its best to facilitate those things and keep Hong Kong's strength